Awesome. Well, hello and welcome everyone to our webinar. I am Danielle Kirkland. I am the Director of Student Recruitment and Belonging here at AACP, and I will be moderating today's session. We'll get started with today's session, how to prepare for credit-based borrowing for pharmacy school in just a moment. But first, just a few housekeeping items. Although you will be muted throughout the entirety of the webinar, please feel free to ask questions in the Q&A window or the chat throughout the webinar. Some of you may also have submitted questions ahead of time, and most of them should be addressed throughout the presentation. But we do have some time saved at the end for any lingering questions. If there are any that we do not get to today, we'll try to answer them in a follow-up email that will go out probably later this week, along with the recording and the slides from today. But without further ado, I will hand it over to our speaker to get started.
All right. Thank you so much, Danielle. My name's Kat Delgrosso. I work at College Ave Student Loans, and I appreciate AACP inviting us to do this presentation tonight. So I've been in the field of financial aid for over 30 years. I've been at College Ave for over 7 years, and worked at a couple of college campuses in the financial aid office over time, and I also used to work at the college board. So I've been doing this my whole career. I do enjoy talking with students and parents as well. So I do hope that you'll be able to pick something up tonight and use it in your imminent life as it relates to applying for pharmacy school, but also beyond pharmacy school as it relates to just knowing about credit and how to not make mistakes and how to, just get some tips about preparing. So part of the reason for doing this webinar is there have been a lot of changes as it relates to student loans. And so over the past year, basically we've been sort of revving up, if you will, for the law that was signed last summer to go into effect this summer. So the law was the One Big Beautiful Bill, and there were some pieces and parts of that law that affect financial aid as it relates to a variety of things. But for your purposes tonight, I'm going to reference One Big Beautiful Bill as it relates to the federal loan programs. And that becomes important for you as you're applying. And if you're already in undergraduate college right now, or maybe you might be, haven't gone to school yet, but you're about to go to school, or maybe you're currently in pharmacy school, I'm going to make sure that all of the audiences have the information that's pertinent to you. So, because there are some differences as it relates to the One Big Beautiful Bill, depending upon if you've already started pharmacy school or if you're new or you will be new to it. So there's some differences in the law that matter. And then I'm going to talk a little bit about, or quite a bit actually, about credit and applying for, you might end up needing private loans, private educational loans, that is, to afford completing your degree. And so I will talk about those loans as well, and how, why your credit would matter in relation to applying for those types of loans. So first, what I thought might be helpful is for us to do a little bit of an overview, or for me to do an overview for you as it relates to what's available for students, basically. So when you're in college, whether it's undergraduate or graduate level or professional level with pharmacy, with a PharmD degree, these are the types of student loans that are available. So there are federal loans and private loans. And what I'll do is I'll just explain kind of the differences, because you may not be familiar with them at all. You may have some familiarity because you've taken out some, but and then maybe you've taken out both types before, but I want to make sure everybody's on the same page here. So first of all, federal loans are, the money is actually coming from the federal government directly. So what that means is the Department of Education is the entity within the government, the federal government, that administers the program for the federal loan programs. On the private loan side, the funding is actually coming directly from either banks or credit unions or private lenders, like where I work at College Ave. And so the money is not coming from the federal government at all. Although I will say that we do have to adhere, at private loan companies, we do have to adhere to federal laws as it relates to truth in lending, which is basically the Truth in Lending Act is really just to make sure that you are receiving transparency as it relates to borrowing for college. So we have to adhere to those federal laws, but the funding actually comes from either the banks or credit unions or private lenders. So that's a big difference between the two programs right there, where the money is actually coming from. How do you apply? So for the federal loan programs, you file what's called the free application for federal student aid, otherwise known as the FAFSA. And on the private loan side, the FAFSA is not required for that. It's not the application for private loans. However, or I should say, rather, the private lenders will have like an online application, and that is really what you use to apply. We do look at creditworthiness on the private loan side. On the federal loans, some of it's based on creditworthiness and some of it is not. So I'll talk more about that. Okay, in terms of the interest rate that you are charged, so anytime you borrow, you pay interest basically on, unless you're lucky to get a 0% loan or something in life. Usually there's an interest rate charged. And so on the federal loans, those are fixed interest rates. And what happens is those are set in July of each year. So for example, right now we're at the end of July. So July of 2026. July 1st of 2026, the fixed interest rate is set for July 1, 26 through June 30th of 2027. So if you were to apply for a federal loan, it would be a fixed interest rate for that duration of time. And then when you are moving into a subsequent year, you would the interest rate would be changing, and it would be whatever it is at that time for that next academic year and so on. So it's fixed for that year, and then the next year you get whatever the new rate is. For private loans, those are fixed and variable interest rates that are available and offered to you. Some lenders will have both available to you. Some will have just a fixed rate. In all my years, I really have never seen one that just has just a variable rate. That's not a common thing that I know. I've never seen it, but if you run into it, it's definitely not a common thing. Usually you have the opportunity to either get a fixed or a variable rate from a lender. So you'll see that. And then in terms of the interest rates for this academic year we're sitting in right now, I have those listed on the bottom of the screen. And so for the federal direct unsubsidized loan, that interest rate is 8.07 for graduate or pharmacy level students. For the Grad Plus loan, which is only available to students if you've borrowed before in your pharmacy program, that interest rate for this academic year is 9.07%. So those are the rates for the federal loans this year, the year we're in right now. And then for private loans, those will range, anywhere from probably 2% and up. So it depends on credit. Okay, now I want to talk about fees just so you're aware what origination fees mean. They're essentially like an application fee. Those words can be used interchangeably when it relates to student loans. So there's a big difference here between federal and private. The federal loan programs charge what's called an origination fee, and that is 1.057% for the federal direct unsubsidized loan for graduate and professional students, and it's a fee of 4.228% for the Grad Plus program. So what that means is that, let's say you apply for a $10,000 loan, your the college or university that you're attending will net 9,000 and change because the government's going to keep 1.057% of it. And then they're going to send the rest to the school. For if you're eligible for the Grad Plus loan, we're talking about a pretty high, that's a pretty high origination fee, a 4.228% origination fee. So again, on a $10,000 loan, that's basically $423 that is kept by the government, and then you net the rest. Now, all that to say, sometimes you still might find that the federal loan is a less expensive option for you than regardless of having a fee attached. So, this is where shopping makes a difference, and you as a consumer would want to make sure that you're picking the right loan for you. And you may take a federal direct student loan or the unsubsidized loan in your graduate level work. And then maybe you'll take a private loan for the rest because you might be able to, get a decent, interest rate. And the big difference here is that the private loans, most of us don't have origination fees. So you apply for a $10,000 loan, and if it has a 0% origination fee, you're netting at $10,000 towards your education at the school. So make sure you are, one message for tonight is make sure that you're paying attention to what your options are when you go to apply, and you're taking what makes the most sense for you financially. And so that's why I want to make sure to kind of level set with this slide. The funds, so when you apply for any of these types of loans, the money's going to go directly to the college or the university. So what they'll do is the schools will take the loans that come in, and they'll make sure that they basically pay their tuition and fees first. And if you happen to be living on campus where they're charging you for room and board of some sort, they will make sure that they get paid first, and then they will disperse to you really a refund essentially of the difference. So if you apply for loans that are greater than whatever the school is charging you, then you'll be able to take a refund for on a per semester basis or a per quarter or per trimester basis, whatever the school uses. And that will help you. And so for a pharmacy school, for tonight's purposes, most students are living off campus by the time you're at that level. You're not, as undergrads, you might be living on campus, but as a grad professional students, you're off campus, you're paying a landlord directly most times, and you're paying for your groceries on your own, you're paying for your own transportation and stuff. But these loans, any of that refund money will come to you, and then you can then use that money towards your housing and your food and everything. So that's how that works. For federal loans, loan maximum. So some of the loans, the federal direct unsubsidized loans do have loan maximums. So I'll show you that on the next slide. And most of those that are available to you, they don't cover your total cost of attendance. So you might need something else to help afford your cost of attendance at the school. For private loans, usually you can borrow up to the cost of attendance. So they give you a kind of a larger dollar amount that you can borrow to help you towards school. Obviously, you only want to borrow what you need, but at least the private loans do allow you to kind of go up to what is it going to cost me this year, and then that way you have the means to cover. Okay, so this is where it gets a little tricky. My last two bullets on the left, the federal loan programs, I've mentioned the federal direct unsubsidized loans. That is what's available to the graduate and professional level student, no matter what, unless you're in default of a federal loan. But Grad Plus loans are available as well, but only if you are a continuing student in your Grad Plus a continuing student in your academic program for this 26-27 year. So let me explain that a little further. The One Big Beautiful Bill Act basically eliminated the Grad Plus program. And what that means is that they only are allowing continuing students in their program to take that loan out up to 3 years or until they get their credential, whichever comes first. So if you borrowed before, and maybe this is your second year of pharmacy school, or you borrowed this summer, you did something before July 1st and that money dispersed before July 1, you're grandfathered in. They consider you a legacy student, and therefore you can use the Grad Plus program, which is a federal loan program. If you're a new borrower on or after July 1 of 2026 in the pharmacy program, then you are not eligible for the Grad Plus program due to the One Big Beautiful Bill. So that is a big distinction for tonight. Make sure you kind of, okay, reference to yourself, like, okay, where am I in this whole scope? Because Grad Plus, I am going to reference the dollar amounts coming up, but if you're not grandfathered in, you wouldn't be able to take out that loan. Lastly, private loans. Technically, I just wanted to also mention that cosigners could help you get a reduced interest rate if you take those out. You don't have to apply with a cosigner as a pharmacy student, but if you do, if you have a good cosigner on there, meaning they have good credit, then certainly that can help you get a reduced interest rate. So just keep that in mind if you have someone available. And there are cosigner release programs for a lot of us on the private lender side. So College Ave, we have a cosigner release program too. So if you have a cosigner who's willing to apply, get you a better interest rate on the application, then just know that eventually you could request to have them removed at some point during the loan. And then also parents and sponsors are able to borrow on your behalf if you wanted. I mean, let's say, for example, sometimes I'll meet if I'm doing like a student orientation program where I'm, standing in front of students and parents and whatnot. Sometimes there might be a grandparent standing there next to the parent and they say, well, we want to help out a little bit. We want to take out a little bit of a loan for the student to go to school. So just know that private loans do offer the ability for either a parent or somebody like a grandparent or a spouse, if you're a married student, or an aunt or an uncle or whomever, to borrow on your behalf. They're not a cosigner. They can actually just apply on a parent loan or a sponsor loan for you. So those exist in the private loan side as well. Make sure to put any of your questions in the chat, and between Danielle and myself, and I have another colleague on the call tonight, Jennifer Roberts, so she will also be answering some questions there. So we'll try to get your questions answered. If you are at the undergraduate level, these are the dollar amounts that you can borrow. So if you're still kind of early on thinking about pharmacy school and you're still an undergraduate student, just so you know, these are the dollar amounts that you can take out as a freshman, sophomore, junior, and senior, including if you're an independent student versus a dependent student. The interest rate this year for the undergraduate level is 6.52% with an origination fee of 1.057. So again, these are the federal direct student loans, and it's undergrads on this slide. If you're an undergraduate level student, these are the amounts that you can take out in the federal parent loan. So it's a federal parent plus loan. The One Big Beautiful Bill changed this loan as well. So now the most you can take out through the federal parent plus loan is $20,000 per year. And then the most that they can take out on your behalf as a student is $65,000. So that is part of OB3, the One Big Beautiful Bill. The interest rate this year is 9.07 for the federal parent plus loan, and that origination fee that I mentioned earlier is 4.228%. So again, these are undergrad. My last slide and this one, these are for undergraduate students. Moving on to graduate and professional level students. So OB3 or OBBBA, One Big Beautiful Bill Act. This is another thing that happened with the law changing that just kicked in for July 1. Pharmacy students who are in a PharmD program, that is your degree that you're earning, you're considered a professional student. And that matters as it relates to my next slide, which is going to give you the dollar amounts that you can take out per year as a PharmD student. If you're in a different kind of pharmacy program where it's not a PharmD, but you're getting something else related to pharmacy in your degree, in your program and school, if it's not PharmD, if it's not one of these 11, then you're considered a graduate student, not a professional student as it relates to the dollar amounts. So think about what you might be interested in doing so that when I move to the next slide, you can figure out where you are. in the scope of things. So Farm D is professional student. Anything else off of this slide that's not shown here will be considered a non-professional or graduate level student. So with that said, for those of you who have been in your program, in your pharmacy program already before July 1, you're considered a legacy borrower, as I mentioned earlier, and these are the dollar amounts that you can take out. The good news is that Danielle is going to send you this presentation so you can refer back to this. You don't have to do screenshots of everything or anything like that. And I don't expect you to remember every single thing here. But I want to point out a couple things. One is that the professional students, you can see that if you're grandfathered in, your dollar amount that you can take out as a Farm D student is 20,500 a year up to 47,167. That depends on, like, certain health programs can take that. So your college's financial aid office will present you with what you're eligible for. And you are, if you are falling on this slide and you have borrowed something in your pharmacy program prior to July 1, you're a legacy borrower, and therefore you have access to the federal direct grad plus loan. And you can take that up to the cost of attendance minus any other financial aid that you have. So again, these are the legacy students, the grandfathered in amounts. And then you can see the maximum you can take out is on the right at, either 138,500 or 224,000 if you're a Farm D student. Moving on to those of you who are going to be new borrowers after July 1, 2026. For those of you who are not quite in pharmacy school yet, but you're heading that way, this is your slide. So with the One Big Beautiful Bill, these are your dollar amounts. So if you're in a Farm D program, you're going to fall into the second row for the federal direct unsubsidized loan, and that's $50,000 that you can take annually with a maximum of $200,000 in the life of your program. If you're taking a different pharmacy level program, not a Farm D, but anything else, you'll be, or not anything, as long as you are taking one of these 11, basically, that I showed you here, you will be considered professional students. Otherwise, you'll fall into that first row, and you can take $20,500 annually and up to $100,000 total. The Grad Plus loan is not available to you if you're new to your program after July 1 of 26. And you do have a lifetime borrowing cap that did not exist on the legacy students. And that is part of the One Big Beautiful Bill, a change as well. And you do have a lifetime borrowing cap of $257,500. So these dollar amounts really do matter because some schools, to get a professional level degree or to get a graduate degree, depending upon where you're going to school, you may need more than what you see here for dollar amounts. And therein lies the rub. So we're trying to help you to learn what is available to you here. And so this is why private loans might be needed for you if you're not able to access like that federal direct grad plus loan, or even if you can access it as a legacy borrower, legacy student, maybe it's more expensive to take the federal program. So that's why it's good for you to be sharp and get ahead of it and see, hey, let me see what's best for me financially. If it's going to cost me a whole lot more money, I don't want to do that. I want to take whatever's best for me. So in the end, I'm paying less. So if you do need private loans to help pay for pharmacy school, the private lenders are generally going to use a credit report and a credit score to determine whether or not, they want to lend to you or not. They want to make sure that they are willing to take on the risk of lending to you. So these are loans like if you go to buy a car or a mortgage or in this case, a private student loan. Generally, lenders are looking at credit reports and scores, and they're typically giving better interest rates and loan terms if you have stronger credit. So the more you prepare to get your credit in shape, the better off you're going to be. You're going to pay less, trust me. Again, I've been doing this for over 30 years, so I I have a lot of experience here, and I'm hoping to help you to get some tips here. So, lastly, on this slide, just in general, cosigners, I mentioned this before, but cosigners can, with strong credit, can definitely help you with getting approved, but also getting a cheaper loan. And the reason why is because lenders are more willing to give you like a better price because they already know that if you are less of a risk to them and you're more willing to pay them back, or a cosigner's willing to pay them back if you aren't able, then they're going to reward you for it, basically. And that same thing goes towards buying cars and houses and everything else, getting credit cards, all that good stuff. So this same information applies to many different types of loans and credit in your life. The current reality for students is what I know from just experience of working with financial aid administrators and students and everything, is underneath the credit system in this country. The way that the U.S. credit system works is that credit kind of it really kind of is a photograph of our lives and what we've done. It says where we've lived. It has all of our old addresses. Our credit reports show whether or not we've been good payers. Whoops. Whether or not we've been good payers, how much credit we've taken out and how much we've used of it. That's available to us. Are we maxing out all our credit cards, or are we kind of a little bit more conservative on that? So all that stuff goes into the credit world. And as long as we're here in the US, and as this stuff kind of follows us all through all throughout. And what happens is when you're in college, or when you're let's say you're just coming out of high school, let's say you have a very limited credit history. It doesn't mean that you're failing eligibility due to making mistakes, but it just means that your credit history is not very long. And so lenders who are looking at your applications they don't really know how to judge it, because they don't know whether you'll be a good payer or not if you're kind of younger in the credit system world. So good credit kind of relies on what you've done over time. And when you're at the graduate or professional level, at least you probably had something happening. You've had at least 4 years of undergrad, and now you've moved into graduate level work. And so that lender has a little bit of information about the risk it is to give you a loan. So that's why I said earlier, some students in the graduate level, they can apply on their own. They don't necessarily have to have a cosigner, because there is something to look at on the lender's part. So that's how that all works. It's not that a lot of times the student tries to apply on their own and then they get denied. It's not because you are a bad payer or anything like that. It's because you don't have a lot of, credit history yet. So you're working on it. So the way that the calendar kind of works, like OB3 and sort of helping you in the short term, is what I want to do here. Good credit can't be built overnight, but I will say that credit can be significantly improved in a 6 to 12 month period. So even if you haven't really built much credit yet, or you've made some mistakes, or let's say you find some errors on your credit reports, and I'm going to tell you how to, check your credit. You can improve things in a pretty short period of time. So the earlier you check on things or start preparing, and you're doing it because you're here tonight or you're listening to this recording, the better off you're going to be. So students may not be credit ready, but you can get credit ready by the time you might need a private loan, or let's say a credit card, or eventually a car loan, or anything like that. Okay, so I'll move on. So these are the 3 credit bureaus that exist. So each of these 3 companies creates a credit report for us, each of us. So Equifax, Experian, and TransUnion are the 3 main credit bureaus. And the way that you are able to obtain, you might say, well, I don't know how to get my credit report. Where do I even start? So what you can do is you can go to annualcreditreport.com, which is the website is here on the bottom. And this is basically the legitimate website. You may go to it and say, this doesn't look legitimate. It is a federally backed website, even though it's a .com. I know that kind of feels funny, but I mean, it's not a .org, it's not a .gov, but it is truly the one website to use. Don't use a different one because you might end up paying for something that is basically available to you for free. The federal government created this site a long time ago, and it used to be that you could do it annually, thus the name of it, annualcreditreport.com. But since COVID, we've actually been able to pull our credit, you, me, and everybody on here, weekly. So you can pull your credit weekly from Equifax, Experian, TransUnion. Here's the thing, you don't have to pull your credit weekly. What I would recommend that you do is to go on to annualcreditreport.com, mark your calendar, maybe do it every 6 months or at least once a year. But if you've had any kind of fraud, maybe someone's stealing your identity and you've been a victim of fraud, this is definitely one of those things where you would want to probably check it more often, because obviously somebody's already taken advantage of you and maybe opened credit in your name or something like that. So this is where you will find that out. And it's enlightening to go on there and see, like, okay, I don't remember opening that credit card. What is that? That's when you can really, get ahead of it and that type of thing. So when you're on that website, you can pull all three at one time. It's just like you pull a PD, you pull up, save it as a PDF for one, then you go to the next one, then you go to the next one. That's what I do. And then you can look at it at your leisure. You can even have somebody help you go through it. If there are some colleges and universities have financial wellness folks that will help you to work through a credit report a little bit and understand it. So there's a lot of resources out there that can help you a little bit. Okay, so I'm going to move on from that. And why credit matters now and beyond. I've already alluded to some of this, but definitely you're going to get less expensive loans, less expensive credit cards. Strong credit really matters. Just going to move my location here a little bit. I've had some folks working on my roof outside and they're very loud. All right. So the other thing is that you are going to also find over time that your cost of housing can be influenced by your credit. So for example, when you're renting an apartment, um, the landlords can actually pull your credit and give you like a no. They can say no to you basically if they find that your credit is not great. So that is something I didn't, you never think of. So that's definitely something that you'll want to remember. And also utilities, if you have gas and electric and you make mistakes and don't pay for, you're late or something like that, all that bad stuff can get reported. If it goes to collections through your utility bills and things that you don't think of it going, to affect your credit, but it can, and it often does. So be careful with, that sort of thing as well. So everything is sort of cause and effect. All the things that we do as consumers ends up affecting what your credit looks like in over your years. Also, when you're applying for a job, the employer can run a background check and run a credit report on you if they would like. It would depend on, of course, the employer, but that is also something that credit can have an implication on as well. So be careful there as well. This is all part of the whole process of just being prepared and having good credit, establish a good baseline, and stick with it. Okay, so starting now makes a lot of sense. So let me talk about some credit myths, just to, debunk them basically. First myth is, do I need to carry a monthly balance to build credit? And the answer is no. You shouldn't carry a monthly balance. If you use a credit card to purchase something, you should try to pay it off that month if you can. And that's still going to build credit. And if you keep a monthly balance, I'm going to talk about this over the course of the next few minutes, but carrying a monthly balance is actually worse. So you don't want to keep carrying a monthly balance. If you have a zero balance every month because you've paid the whole balance, that's building your credit for sure. The second item here that's a myth is if you check your credit, remember I said, go to annualcreditreport.com. If you check your own credit, does that reduce your score? Um, and the answer is no. So let me tell you how the scores work. They basically are on a scoring system between 300 points up to 850 points. So there are a couple of different scoring mechanisms. One is called the FICO score, which is the Fair-Isaacs method. And then there's another scoring mechanism called the Vantage score. So each of the credit bureaus, they use whatever they want to do. So you're either going to hear of a FICO score or a Vantage score. So the higher the score, the better off you are. So typically when you're applying for credit, you don't have to have an 850 to get approved. You're sort of striving for the impossible sometimes. I mean, I know there are people who have an 850 credit score and that's wonderful, but you don't have to be hard on yourself about trying to be perfect. Really, anything in the 700s is also good. So, and some lenders will provide a loan to you or a credit card to you, or a car loan to you even if your credit score is in the 650 and up range. So even if your credit score might be in the 600s, it doesn't mean you're going to get denied. But you might end up having to pay a little bit of a higher price than if your credit was in, let's say, the 700s or certainly in the 800s. But when you check your own credit, it doesn't lower your score. So you can check your credit, it's fine. The third myth here is that debit cards build credit. So unfortunately, they don't. And the reason is because debit cards are not credit cards. Debit cards are money that's coming directly out of your checking account. So it's your money regurgitating through, you've got money in there, you're spending it, and so on. That's not actually building your credit. You do have to have something where a lender or a creditor has given you credit. And that is really what's building your credit, not debit cards, unfortunately. The fourth myth is that if you close a credit card, that's going to help your score. Don't close credit cards. If you pay off your credit cards, um, I will tell you that this is from experience, but over my lifetime, but also, at College Ave, we have access to very strong folks at Experian who have a very lengthy amount of experience as well over time. So a lot of tips that I've learned, even in my time here in my current job, I've learned from Experian and just some of the things that happen underneath that you don't know. I always thought that closing a credit card would help my score, but it actually doesn't. And here's why. Because if the longer you've had like a history, that actually gives you a better score. So if you close something down because you paid it off, um, it's great that you paid it off. Great. Leave it over there and don't rack it up again if you don't really want to use it, but let it stay alive because otherwise, let's say that credit card was your oldest one. Now your oldest one is going to be, less, it's going to be newer. So that's actually going to decrease your score, believe it or not. So that is I just never knew that until I did. And then I realized, oh, okay, well, whoops. I've made mistakes over time as well. Higher income equals higher credit score? No, that is not true. You can have any level of income, and have a high credit score. I could have an income of $22,000 a year out there in the working world and have an 850 credit score because I'm good with my credit. So just because you have, folks who have higher incomes, it doesn't mean they have the highest credit scores. It has everything to do with patterns of how well they've paid over time. Also, the second to last myth on here is that maxing out a card is okay if I pay it off later. That is not true. So maxing out your card, let's say, for example, you have a credit card and it has $1,000 limit on it, and you're maxing it out. So you spent $1,000. What does that mean? That basically means that you have utilized 100% of what is available to you on that card. Part of your credit score, again, the 300 to 850 range of scores, part of that score is about how much you've utilized of the credit that has been extended to you. So if you've maxed out something, already right there, that's dinging your score. That's making that score go down. And if you leave it to pay off later, it's fine if you needed it for something, your tires went flat and you had to max out something. But if you've got to pay towards that when it's due. You don't want to keep a maxed out credit card on your report because that's going to make your score go down for sure. So if you do it with more than one card even, it's going to just keep dinging your score down. Lastly, late payments. So late payments, the myth is that late payments are okay as long as you pay within a few months. Not true. Once you have late payments, this is like the biggest part of your score. So you need to pay, you need to have a good payment history and pay on time. Even if you're just paying the minimum monthly payment, that's better than being late because your score will go down if you're late. All right, so moving on here. So I probably have already mentioned this. I'll make sure, let's see. The credit report in general is a likelihood that lenders are using it to, guess whether or not you're going to likely pay them back over time. If they give you an educational loan or a car loan or a credit card or a mortgage, anything like that. So it's super important to get it right from the beginning. And then you're just going to thank yourself later and say, wow, I'm so glad because my neighbor so and so, is paying way more for her house than the one I have that's equal in value, but, they didn't get a great interest rate. And this is why. I hate to say it, but it's like one of the number one things, one of the top things in the US for us to pay attention to. And certainly, as I mentioned, it can affect the price you pay or whether or not you get, apartment rentals and jobs and things like that. This is the pie chart that is officially used for the, like for the FICO score calculation. So the biggest piece of it is, do you pay on time? Your payment history is the 35%. So the second largest piece is the amount that you owe. So how much of the, like in my $1,000 example I mentioned, how much of the, I've got 5 credit cards and they're all $1,000 limits. Have I maxed them all out? If I have, that's not good. That's going to lower my score because I'm basically have used up a lot of what I have extended to me, or all, in that case, all of what was extended and available to me. The rule of thumb is that you want to keep your utilization rate, or what percentage are you using of, in my example, $1,000. You want to kind of keep it to 30% or less. So it's not a hard and fast number, but it's just a guide that when lenders are approving you, they want to see that you're not maxing out a bunch of things. And ideally, you want to have, maybe only 10% of your credit card being used, or 20 or 30. But once you get higher than that, they see that you're kind of using credit to rely on too much, and that's more of a risk for them, and they're not guaranteed to get their money back if they see that you have those patterns. And then the other percentages are how long you've had your credit history. I have a colleague at College Ave who told a story of how her American Express credit card says member since, and she's around 50 years old. So basically, it says something from in the 1970s. So it's weird to see that because she's thinking, well, but how did I get that? Well, her parents put her on as an authorized user when she was young. And so her length of credit history looks fabulous because she was listed as an authorized user. That is one definite way that you can kind of improve your credit right away, right now. If you can find somebody to put you on their credit card as an authorized user, they don't have to give you a credit card, but if they're listing you on there and they have good credit and they have good credit patterns, it will help you boost up your credit history and all these things you see here on this pie chart. So um, see if you can try to, have that, benefit given to you by someone who you trust and who trusts you. And then new credit is part of the pie and credit mix. Like what kind of credit do you have? Or do you have a bunch of like, Gap card, J. Crew, all these other things? Or do you have a mortgage, a car, an educational loan? Those are better types of credit because they're either secured credit where, you have, a house or a car or your education versus, just a store card, like I mentioned. Um, Okay. So the credit score, I've mentioned this already, so I think I've covered that one. I'll move ahead. All right, now this is the comparison, and again, Danielle's going to send you the presentation. This shows you the comparison of FICO versus Vantage Score and how many people in the US are, have a good, quote unquote, good FICO score or better, or a good Vantage score. And so you can kind of see what the differences are, but essentially you have to be kind of in the mid 600s or up to be considered good or better than good. And that those are the people who are getting approved for things, are those people in the good and up ranges, basically. Steps you can take. So here are just some quick tips. Pull your credit reports from all three credit bureaus, and you want to dispute any information that's wrong. So you're going to find every now and then that your credit report is incorrect. And maybe it's only incorrect on one of the reports, not all three, but you want to definitely dispute the errors. And they're honestly, they make it easy for you, so you can hit a button and dispute any errors. And so they'll go into their research process to try to get it off of there for you. I'll give you an example of an error. Fraud is the number one reason. If somebody, stole your identity and is opening credit in your name, that's one thing. But also just, if you were paying, let's say you were paying your student loan back on time or your car loan back on time, but it's showing incorrectly on the credit report as late. You could definitely dispute that because you obviously have proof of when that money came out of your bank and you can dispute that for sure. So definitely dispute the errors. So understanding your credit, my pro tip to you is understand your current situation, where you are at the beginning here, access those credit reports and put it on your calendar to check it, I'd say every 6 to 12 months. You could do 3, 6, 9, and 12 or whatever it is, but put it on your calendar so you remember to do it. And it's free. So, do it as often or as you'd like. Create a credit history. I mentioned the authorized user, but in being an authorized user on an account, but also like starting small in general, selecting the right credit card for you. I'm not here to promote getting a bunch of credit cards. That's definitely not what I'm saying tonight. What I'm saying is that, or this afternoon, if you're on the West Coast or I'm in the Eastern time zone here. Selecting the right card for you is important to have. Even I'm not promoting to have a whole bunch of credit out there, but you do want to start building your credit. And in order to do that, you're going to need a credit card or something in there to start building your history. So authorized user is like one of the best ways because it's low-hanging fruit. And as long as you're on a person's account that's good, they have good credit history, then you're golden. However, if someone has good and bad habits, just know that some of the credit bureaus will, the good and the bad stuff will go on there on your history if you're an authorized user. So Experian only takes the good stuff, but I think the other two bureaus still look at the delinquencies, as far as I know. But you know what I mean. So just make sure you're getting on someone's authorized user for someone who's, pretty good at paying back things. And then you can do like a secured student card. That might also help you to build credit because it's a credit card, but it's actually your money that you're putting into it. So you're using your money and it's rotating every month, but it's not a debit card. It's like students definitely do this where they're using a secured credit card. It helps you build your credit up. And having a co-signed student loan will help you build a credit up as well. If you're paying your federal loans or your private loans during school, that's building your credit. If you're deferring everything till after you graduate, that doesn't actually do anything to your credit because you're not actually paying on anything. It doesn't do anything bad. It just doesn't do anything good either. It's just kind of sitting there dormant. So if you paid like interest only during school or, you know, send $20 a month towards it or something like that, that's the way to show a credit history and keep it building. So, if you are getting added as an authorized user, my pro tip is you're borrowing their history, not their money. So you're not actually touching their money. They don't have to give you a physical credit card to use. They can, but it's really just kind of borrowing and taking advantage of having their good credit show as your good credit. Then I've already kind of said some of these items on getting your own credit as soon as possible. Avoid buy now, pay later things. I know that sounds good when you're going to buy something online, but honestly, if you don't really have the money to pay it back next month, it's really not gonna help to build credit. It's just kind of snowball a little bit if you get in over your head. So store cards can be the same. Like if you buy shirts or pants or a purse and are using one of those store credit cards, if you really don't have the means to pay it off next month, then you're not really, that's not going to help you. Um, if you think you'll have money over the next couple of months, that's as long as you're paying your monthly payment, your minimum monthly payment, you're good. But just be careful that this stuff can snowball if you start to, you see credit available to you and then you start spending and then it's like, what have I done? So just don't open a bunch of new cards at one time and try to avoid some of these items here so that you can, be more careful. And a pro tip on this part is, you don't have to be debt free. You just kind of have to show that you're responsible in managing your debt. So, like I said earlier, hey, if you graduate from school and your income is lower than you had hoped at first, it doesn't mean your credit score is low. As long as you're good at paying your credit, it's completely separate from your income and what kind of risk you are on paper to a lender or a creditor. Using credit properly is my fourth one, and that is just showing the world that you're not a risk, that you are establishing good payment habits. Setting up auto pay for at least the minimum monthly payment is a great idea because then you don't have to remember to do it. You're always going to be on time as long as the money's there in your account. So setting or adding a calendar reminder at least so that you know to go in and pay. This is how I do it. I mean, some things I have set up as auto pay, but some things I like to go in and pay it myself, like my rent. And so I just know exactly on my calendar when I have to pay those types of things. So auto pay can also give you extra discounts as well as a pro tip. So sometimes you'll get like discounts on student loans if you set up auto pay out of your checking or savings account. I know we're getting close to time here. Let me check my watch. My pro tip for you on this one is to watch your payment history because it is over a third of your score. So if your payment history has not been super great, just know that at least, 6 months time, you can definitely improve your score a little bit. And certainly between 6 and 12 months, you can have an impact. So prepare for it and try to get it up there. So get your score, ideally above 700 if you can. Step five would be to keep that credit utilization as low as possible. So my example earlier of the $1,000 credit card, in here I have a credit card example of $4,000. You can see where the utilization rate for this one is almost 88% for somebody who's basically almost maxed out their card. So try to keep your utilization rate less than 30% if you can. And then make a list. I definitely have done this over time. I've made my share of mistakes, trust me. Making a list of all the cards that you have, what's the available credit that's extended to you, and of that, how much is my balance? And it's also an interesting, if you can't afford to pay it every month, it's also interesting to see how much interest you paid month over month. And then you add that up at the end of the year, and it's like, oh my goodness, I have got to get rid of these, of any outstanding balances. So that is something to strive for, basically. Don't get in over your head. And if you do, just start making a list and, approaching it more methodically. Keeping your card balances as low as possible. Paying before your statement date is only going to help you save interest that's accruing on things. So if you have the ability, even if it's $5, $10 a month, um, pay extra. That's also a good plan. And spreading balances over several cards if possible, because again, with the utilization rates, even if you have one that's maxed out and the rest of them are not, that maxed out credit card is lowering your score. If you're better off having like all credit cards 30% utilization rate or less, because that's going to improve your score versus having anything maxed out here and there. So that's kind of how it works with credit cards. I'm just going to look at the chat because I think we have something here. Um, do we need to send an email in order to receive the presentation? No. Actually, if you registered, I believe Danielle is going to send a recording link and the PowerPoint. Oh, you answered that. I'm sorry. Does making interest-only payments on student loans help to build a positive credit file? And yes, the answer is yes. So even if you just make interest-only payments, or sometimes the private lenders will have we have like a flat pay option, $25 a month. If you're on that, paying that every month is going to also give you a cheaper loan over time. All right, and then I'm getting to the end here. I think this one I have already mentioned, the utilization rate, and definitely avoid carrying a monthly balance if you can. Keep your older credit card accounts open. And eventually they might, if it's dormant for too long, those companies might close your credit cards. So you could make like a small purchase, go to the grocery store, buy some bread, milk, whatever, and then pay it off, just to make sure that they know you're still out there using it. And then they won't just close it down on you, because you don't want to close down, because you want that credit age to still have that longer length of time, because that gives you the better scores. Credit is not about how much money you have, it's about the predictability of your success at repaying. So we've definitely covered that tonight. And then credit freeze is free. So you can protect your credit against those fraudsters who may try to steal your credit or your identity and open new credit. If you freeze your credit cards, or your credit, basically, you're not freezing your credit cards, you're freezing your actual credit through each of the 3 credit bureaus. You will be protected, basically, and there's no cost to you. And it's very easy you can do it on your phone app, of the creditor. You can say, okay, unfreeze it because I want to apply for a car loan today. And it's, usually then you can just refreeze it within a very short period of time, the same day, once you know that they have pulled your credit. I highly recommend credit freeze, especially if you've been a victim of fraud previously. And then credit lock is similar, but it has extra features, but you do have to pay a fee probably for that. So you'll want to see, like, if one of the 3 credit bureaus offers a credit lock, just make sure to do a little reading to see, oh, do I really want to pay a fee for this? At minimum, do the credit freeze. I mean, honestly, it will protect you. Even if you haven't been a victim of fraud, it will protect you from being a victim of fraud. So that's good advice, I think. And then, yeah, just mentioned that. Okay. So recap, lack of credit eligibility is not permanent. Check your credit report. Create a credit history with help from others. Get your own credit as soon as possible just to get yourself building something. Even if it's just a student loan, that's great. Just start paying a little bit during your school years, so that way it's at least building credit. It's not dormant. If you're deferring the whole thing during school, it's really not building credit. So you've got to be kind of doing something to show that you're paying. That's going to build credit right there. And then use credit wisely. Don't go crazy on getting, a bunch of credit cards. You really just want to be responsible and do it wisely. And I've mentioned number 5 a few times. Um, Building credit is the goal, and protecting your credit should be your another goal. And then if you do need private loans, I know I work at College Ave. Obviously private loans, and how we started this presentation is to just know that you have different options available to you. If you don't have enough money to pay for pharmacy school, there are at least private loans that can help you get, your cost of attendance covered, even if you don't fall into the legacy provision within the One Big Beautiful Bill Act. So, just know that there are federal and private loans available to you. We're going to look at credit reports and scores on the private loan side, but again, um, you can definitely apply either with a cosigner or without. Ideally, a cosigner probably will assist you getting a cheaper loan. So I don't know if anybody has questions on what a cosigner is, but I do want to say that it essentially means that you're both on the loan. So a federal direct unsubsidized loan for pharmacy students in graduate professional level work, those do not need cosigners because those are student only. But they have those dollar limits I showed you. There's no cosigner, but they do have the dollar limits. If you need a private loan, that's when a cosigner might be necessary. Um, and that's really what that really means is that if you didn't pay your payment, then the cosigner would be responsible to make the payment. So both people are on the loan on if you have a cosigner on a private loan. And who can it be? It can be anybody who has credit, good credit, or has a strong, ideally someone with strong credit makes the difference. And how to find one would be, asking, starting with maybe someone in your family, or if you're a married student, maybe your spouse, if they have good credit. And that's where I would start. I would also recommend talking with the financial aid offices at your colleges or universities who also may have some other options for you, unique to their institution. So they might have some additional advice and certainly, help you with this whole conversation too. And then why would you need it? That would either to be to get a cheaper price for your private student loan or to get approved if you're not able to be approved on your own. And then how do you know if your cosigner will qualify? Good news, there are pre-qualifications available for a lot of the lenders, including College Ave. We do have that, but a lot of the private loan lenders offer the ability to pre-qualify on their for them. And so you can kind of see, will I need a cosigner? And what my interest rate range might be. So usually you can do both of those things during the pre-qualification process. And that is the end of my remarks. I went a little over the hour. And then let me just see if there's any more questions. What message do you recommend for those that have just graduated on consolidation of student loans? Okay. So if you've consolidated your student loan, oh, sorry, if you have, let me put my video back on. Okay, I turned it off just to make sure I had enough bandwidth there. What message do you recommend for those that have just graduated? Okay, so consolidating. So here's the thing about consolidation. If you have federal loans, you want to be careful before consolidating or refinancing over to. So consolidation is kind of the same thing as refinancing, but consolidation is the terminology used for federal loans, whereas refinancing is the terminology for what private lenders offer, like where I work. So it's kind of semantics. It does similar things, but with the federal loan programs, sometimes there are protections For example, if you're going to be working for a nonprofit, there is a loan forgiveness program. At least there currently is. It's been a little bit politically up in the air, but just know that you want to check that out before you consolidate your federal loans because you don't want to be giving up something where there might have been forgiveness options available to you for the federal loan programs. And that has everything to do with um, um, basically working like more on the nonprofit side. I would recommend going to this website. It's studentaid.gov, and that is the legitimate website where the Department of Education, let me put it in the chat here. The Department of Education is telling you everything about the federal loan programs, and it's the most current you're going to find. I think sometimes they're a little lagging behind, but a lot of times there is really good information there, and it should be accurate. That's my best advice on the site to go to. So the student who asked that, if you are looking to go into that where it could be public student loan forgiveness available to you, then I would be careful doing a federal loan, then I would be careful putting all your loans together into a refinance loan. However, if you're not doing that and you're just going to be working for you're not going to qualify for that, then sometimes just putting all your loans together into one loan will make it a lot easier for you to make the payment every month, to know I only have one payment. And sometimes you can get a better interest rate by doing that because you might have interest rates that range from anywhere from, 6.52 is this year's federal rate, what I said for undergrads. You might have rates that range from 6.5 all the way up to 18%. But if you apply for a refinance loan and you can qualify for 10% and know that you can pay less over time, and you're not looking at federal loan forgiveness, then I do think it makes it easier on students or graduates to deal with it because you don't have to keep track of 5, 6, 7 different types of payments every month. So I just want you to be careful of the federal loan provisions. That's all. Mhm. So that was the last question I see there, and I believe I answered otherwise the questions that were there. And
Yeah.
Danielle, thank you for answering about the recording and the slides.
Yeah, absolutely.
So,
Um, yeah, thank you so much. I just want to pause real quick to see if anyone has any last minute burning questions that they want to absolutely get answered tonight. Please put them in the chat. So I'm going to pause for a couple of seconds here to see if there is anything. But like I said, we'll be sending out the recording as well as the slides, and even any websites that Kat mentioned tonight, like studentaid.gov and other things. We'll put that all in a follow-up email that will go out later this week. We have your contact info when you registered, so you don't have to reach out to us for the recording or anything. And it looks like we don't have any questions coming through. So, thank you again all for attending this session. Please join me in thanking our speaker for this really informative session. I know I definitely learned a lot, and I hope you all did as well. And yeah, be sure to check out the recording and any resources that we send out afterwards. Otherwise, have a great evening. Thank you so much.
take care, everybody. Good luck.